Welcome to The Explainer. Today, we're digging into a really fundamental metric in finance, the interest coverage ratio. And trust me, it's a number that can tell you a surprising amount about whether a company is built to last. Okay, let's jump right in. So here's a question that trips up a lot of people. You see a company, it's reporting profits, maybe the stock's even doing pretty well, and then bam, news breaks that it can't pay its bills. How on earth does that happen? Well, the answer usually comes down to the huge difference between profit on paper and actual hard cash in the bank. And the key to unlocking this whole mystery? It's a simple number, the interest coverage ratio. You can think of the interest coverage ratio, or ICR for short, as the first thing a credit analyst checks, like taking a pulse. It's a quick, super powerful tool that acts as an early warning signal. It tells us if a company can even afford the interest on its loans, which, let's be honest, is the absolute bare minimum it needs to do to stay in business. So what is this thing exactly? Well, the ICR, which you'll sometimes hear called times interest earned, is all about solvency. In plain English, it just measures how many times over a company could pay its interest bill using the money it makes from its day-to-day operations. This isn't about its total profit. It's about its immediate ability to handle its debt payments. And the formula itself, it's beautifully simple. It's just your earnings divided by your interest expense over a certain period. At its core, it's basically a tug of war between two numbers: what the company is actually earning from its business versus what it's legally required to pay its lenders just in interest. All right, so what's a good number to look for? Well, the gold standard, the widely accepted benchmark for a healthy company, is a ratio above 2. See, an ICR of 2.0x means a company is earning twice as much as it needs to cover its interest. That gives it a really solid safety cushion, a buffer for when business unexpectedly slows down. Now, this is where it gets really telling. This table lays out the whole risk spectrum perfectly. Just look at that top row. Anything below 1.0x, that's the danger zone. That's a high probability of default. Lenders see that number and they start to panic. That middle zone between 1.0 and 1.5, that's kind of shaky ground. You're surviving, but just barely. But get above 2.0 and boom, you're in that healthy credit profile zone. That's where you want to be. Okay, so it seems simple, right? Well, this is where things get a little more complicated. That simple formula we just looked at has a hidden trap. What exactly do we mean by earnings? Because the choice you make for that top number, the numerator, can totally change the story the ratio tells. So you've got two main contenders here, EBIT and EBITDA. EBIT, that's earnings before interest and taxes, is the conservative, by-the-book, official accounting metric. It includes non-cash costs like depreciation. EBITDA, on the other hand, adds that depreciation cost back in. The argument is that it's a better proxy for actual cash flow. Now, this choice isn't just for the accountants. It has huge real-world implications for how risky a company looks. And here's the kicker. Using EBITDA can be really, really misleading. Because it's not an official accounting number, management has a lot more wiggle room. They can make, let's say, questionable adjustments that puff up the number. But its biggest, most fatal flaw is that it completely ignores a very real, very necessary cash expense, CapEx. That's the money a company has to spend just to maintain its equipment and buildings. So EBITDA can make a company look way healthier than it actually is, hiding some serious problems right under the surface. Having a healthy ratio today is great, but it doesn't guarantee anything about tomorrow. The real test is how that ICR holds up when things get tough. So let's do that. Let's put this ratio under a little bit of pressure with a couple of common economic stress tests. First up, rising interest rates. This is a direct attack on the bottom number of our ratio, the denominator. As interest rates go up, a company's interest payments increase. So even if its earnings stay exactly the same, the ICR gets squeezed from below and shrinks. And just like that, that safety cushion gets smaller. And then you've got stress test number 2, a recession. This one attacks the top number, the numerator. When the economy slows down, sales drop and earnings fall, so the ICR gets squeezed from the top. Now, can you imagine what happens when both of these hit at the same time? Rising rates and a recession? That's the absolute perfect storm for corporate bankruptcies. And this is where things can really spiral out of control. It's something economists call a financial accelerator. See, as a company's ICR starts to fall, lenders get nervous and see it as riskier. So what do? They charge higher interest rates, or maybe they just stop lending to the company altogether. Of course, this makes the company's financial situation even worse, which pushes the ICR down even more, and the whole thing just speeds up. It's a truly vicious cycle. So we've seen that the ICR is useful, for sure, but it has a massive, glaring, fundamental blind spot. A flaw so big that if you rely on this ratio by itself, you could completely miss the warning signs of a company in serious trouble. Think about it. The interest coverage ratio measures how well a company can cover its interest payments. But when you take out a loan, you have to pay back more than just the interest, right? There's another huge mandatory payment, one that the ICR completely, totally ignores. And that payment is the principal. It's the original loan amount that you have to pay back over time. A company could have a fantastic ICR, easily covering all its interest, and still go bankrupt because it simply doesn't have the cash on hand for a giant principal payment that just came due. And that's really the bottom line here. Defaulting on your principal is just as bad as defaulting on your interest. Either one can send a company straight into bankruptcy court. So any metric that only looks at one half of the total debt payment is, by definition, giving you an incomplete and frankly a potentially dangerous picture of the company's health. Okay, so if the ICR has this fatal flaw, what do the pros use? What do real credit analysts look at? Well, they don't just throw the ICR away, but they use it alongside more powerful, more comprehensive tools that paint a much, much truer picture of a company's ability to survive. And the two key upgrades in the professional's toolkit are these. First, the debt service coverage ratio, or DSCR. And second, the fixed charge coverage ratio, or FCCR. These two ratios directly fix the weaknesses we've been talking about. The DSCR is the direct solution to the ICR's biggest problem. It asks a much smarter question. It asks, does the company's operating cash flow cover its total debt payment for the period, both the interest and the principal? Right away, this gives you a far more realistic view of whether the company can actually pay its bills. But the real gold standard, the metric that sees almost everything, is the FCCR. Think of this one as the ultimate financial stress test. It starts with a company's cash flow, but first, it subtracts the money needed for CapEx, reinvestment in the business. Then, it compares that leftover, truly available cash against all the fixed charges, interest, principal, and even things like rent and equipment leases, the whole shebang. This table just sums it all up perfectly. You can literally see the evolution down the rows. You start with the ICR at the top. It's narrow, it only looks at interest, and that key blind spot column is massive. Then the DSCR gets better. It adds principal into the mix. But look at that bottom row, the FCR. It gives you the most complete, honest picture. It uses a truer measure of cash and includes all the mandatory payments. There's simply nowhere for financial weakness to hide with this one. So, at the end of the day, what's the big takeaway here? It's that profit on an income statement is just an opinion, but cash is a fact. The ultimate test of a business's survival isn't whether it's profitable, it's whether it generates enough real, actual cash to meet all of its promises. And knowing which ratio to use is how you find the real answer.